very, very quickly. Okay, I'm guessing you probably have. My sincerest apologies if I'm insulting your intelligence. It's certainly not my intention. Okay? But I did get a couple of questions, so I thought, well, let's just talk about it. Okay. So I will, my sincerest apologies, I was supposed to upload a single-page format version of this book as well, and I will. This is obviously the two-page layout. I personally prefer... Oh, this does appear to be the single-page version, is it? Okay. My apologies, obviously I did. It's more organised than I thought. Just give it a second to load. Oh no, it is the two-page layout. Okay. Sorry, it appears to be labouring slightly. It's a rather large file when you're using it in PDF view. Just give it a moment. Anyway, how has your week been? Has everyone had a good first couple of weeks in the program? Yeah? Is everyone appreciative of Melbourne weather? It's never this cold in Melbourne. It's sunny all the time. Alright? This is just a once-off. Rest assured it probably won't happen again. I've got statistics to back up any claim. We go to like 4 confidence intervals at almost. Yeah. Alright, anyway. So you'll see these QR codes in the corner. Normally there's a dedicated app. I designed this in such a way that it works with any QR code scanner. So essentially, if you want additional information about the content on the page, you just scan the QR code in the corner and you'll be able to access some additional material. Okay? A couple of general housekeeping matters too. I put a summary of the necessary readings into that guide, into that outline. But just to be clear, look, there isn't really a huge amount, to be read. When you think about it, it's just 278 pages. Okay, 2-page layout pages, so it's not that much. More often than not, as I said, on a week-to-week basis, it's really just one chapter that needs to be read. And you might find that if you're comfortable with that material by virtue of your previous studies, you might need to read it in full. Just sort of use the material that you need as you need it. Okay. There are some good sections in here, though. For those of you that sort of want to move beyond the standard material, there's some good material on charting and time series forecasting in particular. For those of you that are so inclined. Okay. Just a couple of other general housekeeping matters before we kick off as well. Your assignment is available for download. Not sure why seminar. I thought there's seminar 3. All right. For a second, I thought I hadn't given it to you. It's a very straightforward assignment. This is, for many of you, likely to be your first long-form assignment. So please bear that in mind. Our expectations are not outrageous when it comes to assignments at this stage. The goal of this unit, in many respects, is to prepare you for many of the subsequent units. So, yes, the assignment is a research report and involves you formatting a paper accordingly, but it is the first occasion that you'll be doing this. So we do approach it with, I'm not going to say a degree of levity or lightheartedness, but we do acknowledge that there are likely to be some challenges, given this is sort of the earliest vestige into doing this kind of thing. All right. The other thing to be really mindful of is that I'm very available to offer assistance to the extent that I can. So please be mindful of that. I'm just going to go through the overall structure of the assignment. Essentially, it's a research report that involves you adopting a particular style of writing depending upon the question that you're looking at. I'd say for the most part, many of you are going to be using a case-based approach or a research article, research essay approach, depending on the topic that you choose. And by virtue of that, your paper is likely to be constituted by an abstract section, introduction, literature review, methodology, findings, and conclusion section. That tends to be the sort of archetype of those papers. All right. The complexity comes from the fact that you're supposed to choose a topic. Okay? You are supposed to choose a topic, but I have given you a list of topics as well. just to kind of get people thinking about this. You can choose from that list, most certainly. But I would love if people were to explore things that they're particularly passionate about, that broadly align to the material that we're covering off on in this program. So in terms of the word count itself, the unit guide now says 4,000 words. Okay. But it may well be that some of you write with precision and write in such a way that you can write technical documents in a fairly short report. I find that to be uncommon, and most people generally don't write with concision, but it may well be that your report is only 3,000 words. That's fine. Equally, if your report is 4,500 words, I'm not going to be too perturbed. I do find that when people are new to writing research reports or any sort of corporate document, they tend to write in a fairly excessive way with a lot of largesse, with a lot of unnecessary scaffolding. That isn't really what we want from you here. The idea is that you're responding to that question with concision in a logical way, employing a logical structure. It's often the same when you write the response to exam questions for the first time. I don't know if anyone's had a look at or been involved with any sort of assessment process before, but I do find that people often offer a huge preamble. Like they will tell you everything they know about the subject. Have you ever watched a game show and when someone doesn't know the answer, they'll tell you 10 proximate things about that question, but they won't get to the point? Obviously, you're not going to be rewarded for all of that excess. Okay, so the idea is that you write with concision, you try to write in a way that is consistent with writing in the real world. I have a lot of materials that I can provide via the platter. I'll certainly give you guys access to a number of books that introduce you to writing. I know that most people don't have time to write a book on how to write a research essay and how to write a research report, even if they are authored by exemplary authors. So this is a really simple resource online, written by an academic that I think is quite good. It's called Explorable. In a couple of dozen pages, introduces the process. In fact, it has a one-page summary of every section, explaining how to go about writing your first paper. So rather than give you something of my own, I think this is quite a good, simple resource that you can use if you feel it's going to be worthwhile. All right, I'm just going to briefly cover off on some of the topics and explain to you how you might go about iterating them, or, for argument's sake, providing alternative topics based on what we are discussing. What am I doing? Clicking on resources. My sincerest apologies. All right, here we go. And I do like that people have been so active in telling me what they'll be doing. That's good. I'm appreciative of that. But bear in mind, you don't have to choose from this list. I am going to add a few more topics as well. I put together a few more on Friday that I'm going to upload today. Now, if you do choose to change your topic, I encourage you to just sort of come online and edit your original comment, just so it's apparent that you've nominated an alternative topic, or actually reply to that same discussion thread. So here are some topics that I think would be quite compelling, that present you with an opportunity to respond in both a quantitative and qualitative way. I do think that the one request, or indeed requirement of any report, is that you offer some level of substantiation. Some of the questions, some of the problems are such that that's going to be a little bit more challenging than in other cases, but I think that every question does allow for some level of third-party substantiation, or the use of third-party material in support of your claim. It can't just be, some sort of broadly qualitative narrative with no substantiation from third parties. It's not, a fun personal writing project. The idea is that there is a little bit of rigor there, that you're looking at third-party resources if they're not available, if for argument's sake the question has been considered but not to any great extent, then you find some data, you find some industry information, you source some relevant third-party information, and you use that to frame your response. So see, here are some of the case questions that I thought might work quite well. So the first just sort of looks at Amazon's entrance into the Australian market and the impact of the work of Amazon on retail groups. So I think everyone's a little bit concerned about Amazon at present. They've done nothing wrong other than be remarkably efficient at what they do. And look, some might argue in the context of certain markets, some slightly disingenuous things, but for the most part, they've been able to create a structural and competitive advantage by virtue of their efficiencies. I think we've seen a number of corporate insolvencies involving Australian retail groups in recent months, and there is little doubt that we're going to see more over the course of the coming months, given that there are a number of retail groups that are teetering. What role does, or indeed what role did Amazon play in that, if any at all, and what is likely to happen to the market and indeed these key players by virtue of Amazon's entrance into the market? So one way to look at this would be a largely qualitative analysis with a view to looking at market share statistics and trying to comment on how market shares are likely to shift. Another might focus, for example, on the financial side and the financial performance of these key ASX players since the entrance of Amazon into the market, or indeed some sort of lead-based study looking at the performance of these enterprises upon market notification that there was going to be a degree of localization in terms of Amazon's program, Amazon's distribution program. I think that would make for a really good report. The next one, I think, is probably one that is going to be popular with those who have an understanding of Australian markets. And that's an analysis of the negative gearing laws that are in place in this country and their impact on property prices. So if you want to go down a largely quantitative path, you could try to do some sort of difference in difference or staggered entry strategy study, looking at how the change in these rules and pronouncements, the change in these laws, has actually impacted upon property prices by actually measuring the regime effect. Or you could do it in a quasi-quantitative and qualitative way and simply try to analyse structural changes at key points in history have impacted upon property prices. That's a slightly more qualitative approach, but you'll find that there is a little bit of third-party information out there around this issue, albeit it's not one that's been explored to any great extent. The next topic, I think, is one that is rather topical at present by virtue of what's happening within the franchising space. Locally, I'm not sure if you're aware of this, but there's been a lot of debate and conjecture about the appropriateness of a number of the groups. I shouldn't say appropriateness. Many have questioned the practices of a number of the major franchise owners and franchise leaders in recent times within the Australian franchising industry. Many have called for some substantial changes to franchising models and franchising laws. And so I thought it would be interesting for someone to actually explore how these listed franchise group owners are actually performing. So there are a handful of companies that actually collectively hold the vast majority of the franchise IP, and many of them are in fact listed Australian corporations. A number of them are unlisted as well. Some sort of exploration of their performance, I think, would be quite interesting. All right. The next question is more of I would envisage more of a quantitative question, focusing on the ASX and the performance of IPOs since 2017. So essentially benchmarking the performance of all IPOs that occurred in 2017. Okay? So it requires that you look at recent IPO activity. How have these recently listed firms performed in terms of perhaps 1 week ex-post performance, 3 week ex-post performance, and then slightly more long-term, 5 weeks, 6 months, so on and so forth, with a view to actually providing some sort of narrative about recent IPO performance. Right? There's a huge literature around this. Ex-post IPO performance is something that academics devote an outrageous amount of effort, toward researching. So you're not going to be short of references. Again, this question can be responded to with both a quantitative model and a qualitative model. So you can find an appropriate balance between the two. Okay, I'll just cover off on the others a little bit more quickly. The next question, opportunity or indeed assertion, the next report topic, focuses on the market for decentralized lending. So in recent years we've seen this market evolve, and increasingly people are not using traditional lenders to access funding. People are pursuing funding opportunities through direct funding arrangements, very popular in North America, but also increasingly through platform-based models. And so in Australia we have a number of financial services providers operating in that space. Okay, and those of you selecting that topic, if you find the material hard to access, if you're finding it hard to quantify, drop me an email, and I can certainly show you where some of the industry data is if you would like to look at this more. The next question focuses on the application of blockchain to the financial sector and associated industries. So blockchain is important. It's not the most important thing in the world. Don't treat it as the most academics do. It's something that's essentially just a flash in the pan. It's really not. Blockchain is going to really change the way we engage in business and commerce, and it is already causing us to engage in business and commerce. A report focused on this topic would need to essentially explain the blockchain structure, essentially how the blockchain model works, and how it can be, and indeed has been used in the context of finance. I think this is a really fascinating topic, and again, one that might require a little bit of technical acumen, but if you devote the necessary time to it, I think it'll be quite a rewarding one. All right, the next question is one that I'm quite interested in, and that's the future of IPO activity in light of changes to equity crowdfunding laws. So increasingly around the world, equity crowdfunding laws are being enacted. These equity crowdfunding laws allow firms to raise generally between $5 and $20 million a year through a non-broker intermediary. It's a very different model for fundraising, and we've not seen such a major change in fundraising law since the establishment of the US SEC. Right, so we're talking about 70 to 80 odd years. It's a significant thing, and it's not talked about enough. There was a real air of conservatism around fundraising when the SEC was constituted and the Exchange Commission Act was enacted. Okay? We've generally seen crowdfunding laws around the world reflect, I guess, a shift in mindset towards greater incentive for entrepreneurialism and greater support for entrepreneurialism. And that's a really seminal shift within industry. Okay? Is that going to create a different model for IPOs? We're going to see more late-stage ventures go to IPO. Technically speaking, most firms that do go to IPO are very assuring, but there are a number of early to mid-stage enterprises that do go to IPO, particularly within the research industry. Is that going to change? Are we going to find now that much of the profit potential, much of the opportunity is exhausted prior to a firm going to IPO? All right. The next one again is one that I'm a little bit close to, and that's equity crowdfunding laws within BRIC countries. Essentially looking at the present framework and the legal status of non-IPO based public fundraising. So essentially the laws relating to equity crowdfunding. What's happening in Brazil? What's happening in Russia? What's happening in India? What's happening in China? Okay, these economies are particularly important, so we're going to focus our attention on these countries in this focused analysis. All right. The next question focuses on trends within the venture capital market. So you'll be able to find data on this quite readily, because venture capital data, broadly speaking, is available through a number of private and public providers. If you take an Australian approach to it, you'll find that ABCal releases a lot of data as well. What are the types of transactions that are being funded? Who is being funded, and to what extent? Right. So this is a really good introduction to our market and indeed what we're good at. Right. You'll find, rather remarkably, that fintech in Australia is doing remarkably well when it comes to fundraising. We've also had a number of very successful ICOs in recent times that I would include within this category as well. Okay, that leads on very well to the next question, an analysis of the Australian fintech industry. Who are the exemplars and firms to watch out for that path pre-IPO? So, the vast majority of Australian fintech firms have not gone to IPO. A number are very, very close. Prosper indeed declared that they were likely to go to IPO, but they haven't. Okay. You'll find that there are 14 exceptionally well-known Australian fintech brands that are pre-IPO, and beyond that, there are dozens and dozens of others that are likely to be on that IPO path as well. How close they all are is really contingent upon their performance and indeed, to an extent, what you think of them, because it's likely to be consistent with the views of many others with respect to these firms. They're operating in a very competitive sphere. I would love to see some of you formulate views and positions on who is the closest, what aspects of their technology you indeed find compelling, and why you find them to be compelling. So again, a very, very good one for those of you that are genuinely passionate about finance and genuinely passionate about fintech. All right, the next question relates to state-based crowdfunding exemptions in the United States. I noticed that no one has picked this question yet. Okay, it seems like a hard question because yes, there are a lot of states in North America. But when you think about it, the answer to each of those sub-questions is remarkably straightforward. So I would encourage some of you to look at this question as well. What are these state-based crowdfunding exemptions? Well, in the US, through the Jobs Act, they enacted their new crowdfunding framework, their crowdfunding laws. But most states felt that the laws didn't go far enough. And they weren't going to come on quickly enough. So, within months of the laws being enacted, 17 states enacted their own state-level exemptions. The US is a much looser federalism than Australia is in many respects. The states are very, very strong when it comes to rule-making and indeed the powers that the states have in many respects are greater than the equivalent powers within the states of Australia. That is not to say that they're a closely aligned country, it's just the nature of their democracy. And so, yes, 17 states enacted changes within months of the initial laws, and now almost every state has enacted a state-level crowdfunding exemption. Why do you think they're doing this? Why do you think states are saying we want our laws to be even more strongly aligned to entrepreneurialism and innovation? We want to provide even greater incentives to innovators. We want to make it even easier to raise money within our state. Why do you think states might be doing that? It's a rather simple response. They want their state to be the most viable when it comes to investment. And so I'd love to see some people focus on this issue. Okay, and the last one just focuses on Australian equity crowdfunding. Who has achieved crowdfunding success through the new legislation? So this would involve visiting all of the non-broker intermediary sites, of which there are only really 3 major sites, and reviewing transactions. All transaction data is public. Okay. Morning, guys. All transaction data is public. Okay. So you'll be able to go online, analyse each transaction, and identify those that have been successful and those that have been unsuccessful. So, for example, the biggest platform, or most popular platform at present is virtual.com. They were the team behind Posable. We have a strong alignment to Posable at Deakin because we were their first university partner. We've used the platform on a number of occasions to raise funds. And I should also mention that I've done some work with Posable while aligned with Optus as well. So, again, those of you that have an interest in this topic, you'll find that it's a very interesting one. And there isn't a huge amount of complexity here from a technical standpoint, but there will be a little bit of background research that needs to be done. So not a technically heavy topic, but again, there is still a research rigor. I've endeavoured to make every question, or indeed every topic that I've suggested, involve a similar amount of research rigor or effort. All right, moving on to our final few. A couple of questions about Brexit. I'm going to be offering a few more under the Brexit category because I think Brexit is fascinating. It's always interesting when something significant happens in the context of the market because we can look at pre and post events. We can look at how significant the event itself has been. Okay. Why do you think the event has been such a significant one, such a seminal one? How has the event shaped markets? What have been the most significant implications for markets? So the initial question just focuses on debt and equity. All right, so you would go online, look at the relevant markets within the Eurozone that you choose to nominate, and you would analyse the pre and post effects of Brexit. So what happened prior to Brexit, what has happened next post? How is the market performing now? Was it a good event, was it a bad event? I mean, that's for you to decide. Okay. The next question just sort of posits that a little bit more directly with a focus on employment, property and retail markets rather than debt and equity. Okay? There is a really great website on, sub-website or subdomain on the Alzheimer website. No, the Taylor and Francis website, that provides you with a huge amount of data on this issue, for those of you that are looking at this question. Okay, on the Taylor and Francis website. All right, the next question is just kind of a fun one, I think. Donald Trump is an interesting fellow. I learned a great deal of economic theory from listening to him. It's like you know, if you were to combine Adam Smith with John Stuart Mill, you know, sprinkle a little bit of John Nash. That's who Donald Trump is to me. I think he struggles to communicate it, though. I think that's where he loses people. No, I'm being a little bit facetious, but he's a fascinating person, and he's really, if nothing else, everything he does has an impact, and it would be really remarkable to actually analyse that. All right, so how does Donald Trump fare when it comes to policy? What have been the implications of the policies that he's enacted? Okay, so this is a little bit of an event-based study. The idea would be that you actually mark on a calendar the key policies that he's enacted and try to identify what's happened pre and post those policies. Have they elicited some change within the relevant market that he's tried to impact? Okay, and obviously our focus in this course is on financial markets, so the first question focuses on equity markets in particular. So how have equity markets performed under the Trump administration? A couple of key things to be mindful of when doing this kind of analysis. Try to think about the flow-on effect of the Obama administration policies, if you can. Okay. And try to be mindful of the fact that during the earliest vestiges of his presidency, he wasn't actually enacting policy. He was really just coming to terms with things. So try to, as much as possible, identify some sort of direct association between what he's done and the outcome. Otherwise, it just becomes a bit of a mess in terms of analysis. All right, and so Trump versus the rest. This is essentially a project that would focus on looking at the first year of his administration and comparatively the first year of other leaders. You'll find that a number of people have done this. The critical thing to do is to really account for lag and lead effects well. Okay? What I'm trying to say is, don't give him too much credit for job creation during the first few months. All right? Because that would be unfair on the Obama administration, I think. That's just my look. I'm not going to bias your analysis. You can formulate your own opinion. Okay. The final few topics for the first topic set relate to financial service provision within remote and rural communities. Really interesting question. This is one I spent a lot of time talking to the media about, and in recent times in particular, by virtue of the banking sector inquiry, there's been far more interest in this topic. I would love to see other views on this, what people think about the quality of service provision within this country or indeed another country that you nominate. It's a very open-ended topic. You can choose to vary it however you deem appropriate. The next question is rather specific. It focuses on the M-Pesa model that was so successful in Kenya. It's a mobile banking model. I'd love to see some students focus their analysis on the M-Pesa model and why the M-Pesa model was so successful. The next question sits at the juncture or the intersection of social enterprise and traditional finance. So rather unremarkably, many have discovered that microfinance-backed collateralized debt obligations have performed better than many traditional collateralized debt obligations. Kind of remarkable because when people think about microfinance, they think about all the deal risk and deal complexity. So this question focuses on comparing microfinance CDOs with traditional CDOs. Okay. How have they performed in recent times? You'll come to discover post-GFC, the figures are kind of startling in many respects. Look at the post-GFC performance of microfinance CDOs relative to traditional CDOs. Okay. have a look at how the world has changed. Okay, and so the next question is just a broad one. I want to give you a broader option for those of you who have a passion for microfinance. So this would involve collecting data on microfinance trends within the emerging world and analysing just how significant microfinance has become. Well, my apologies when I say microfinance, microinsurance. In this instance, microinsurance has become. Microinsurance in India and China is now a very, very big thing, very big market. A number of firms moved into China and India in the 80s and found it to be a very complex deal environment, and they left. I think many regretted it, and the number of returns and a number of the most successful offerings that they brought to market have been microinsurance offerings, quite frequently attaching an insurance contract to a traditional good or service. So I think it's quite a remarkable market, an innovative market, and certainly one that I would love to see some students focus their attention on. All right, so that's a broad overview of the topics that I've introduced. I would really encourage you all to look beyond these. I know that it's early in your study program, but I'm sure that you probably thought about issues proximate to these. I'm sure that you would have thought about things that you would like to focus on in the past in terms of your own vocational pursuits and careers. Why not frame a topic that allows you to do both, address the requirements of this unit, while also focusing on something that matters to you? If you have any concerns about your topic, just email me. I'll usually get back to you within about 12 hours with some comments and some thoughts or insights, possibly some variation on the idea to make it a little bit more workable in the event that I think it could be challenging. All right, so I would love to hear from you all. You don't need to choose these topics. You're entitled to nominate your own if you would like to. All right, any questions before I get into today's lecture? Today's a fun one because we actually get to do financial maths today. All good? All right, well, let's get into today's material. Okay. So number 3. All right, so today we're going to be focusing our attention on the slightly more applied issue. A couple of things to be mindful of. The textbook goes well beyond these issues. This is really the scope of what you need to understand, what we cover off on in the lecture in particular. So these lecture notes and the questions that come shortly. You don't need to understand any of the time series econometrics unless you would like to. That's just more for your own interest. Okay. So today we're going to be looking at interest rates, both the theory and some of the underlying practice. So some of the introductory methods that you would use to engage in forecasting. So our focus is going to be predominantly on using implicit rate theory, basic geometric average calculations to try to find rates. Okay. Obviously, in the real world, we would probably devote more time and effort to traditional time series econometrics and machine learning-based methods, for argument's sake. But this is where we start. So, come the end of today's discussion, you should be able to do the following. Explain why a central bank uses interest rates to implement monetary policy, describes short and long-term impacts of rate changes, outline approaches, explaining how rates are set. You're going to also understand the basics pertaining to yield curves and yield structures. And we're then going to devote some time to the shape and slope of yield curves, essentially looking at how we can use yield curves to comment on things that are going to happen in the market, and indeed looking at market data, comment on what's likely to happen in the context of the yield curve. Okay? Sometimes we use the expression Granger causality to explain that association. What is the direction of the relationship between certain metrics within the market certain factors within the market and interest rates, and equally how do interest rates impact upon the market. Okay, we're going to start by providing a little bit of macroeconomic context. In most developed countries, monetary policies focus on impacting the cash rate, the overnight interbank rate, the primary interest rate. But that isn't true of all economies, and that's probably where we should start. Within some economies, a number of old world textbooks use rather unfortunate language to describe these policies, but in a number of economies, their monetary policy actions have multiple goals and multiple motives. The problem with having multiple goals and multiple motives when engaging in a policy program or action is that you can't do everything. Okay? So you'll find that a number of emerging nations will intervene within their markets, not just to influence the cash rate, but quite frequently to stabilise currency. Okay? They engage in currency stabilisation programs. When you're engaging in a currency stabilisation program, but also trying to elicit a change in the primary rate, the overnight interbank rate, the cash rate, you'll find that often you can't adequately satisfy the needs or wants of either policy well. Okay? So that's something to be mindful of before we proceed. But in Australia, while we retain the discretion to intervene in our markets to stabilise our currency, it is incredibly rare that we actually do so. We operate a very clean float. We allow our currency to freely move. And we focus most of our attention on the cash rate, the overnight interbank rate. And we've been quite successful in this regard. Our monetary policy program has been a very successful program in terms of the ability of our monetary policy program to elicit a change in the economy, to initiate a change in the economy, or to stimulate a change in the economy. So, these are the primary reasons that a central bank might choose to influence the interest rate in the context of an open market operation or monetary policy action. Because inflation is above a target range. Textbooks frequently talk about the notion of excessive growth in GDP. I think I've included that as well, but I think the term or the assertion itself is a little bit unhelpful. The reality is GDP growth is good. Okay? Improving the rate of change in GDP, ensuring that it's positive, is a good thing. The reason some don't consider it to be good is because it comes with inflation. Okay? Let's take a moment to consider China and India, the two fastest growing economies in the world. Okay? What has been the demarcation of that really great improvement in economic production? What has come with it? What has been the unfortunate aspect of that rate of change? Sorry? Yeah, inflation. That's exactly right. So, excessive inflation, so very, very, very high rates of inflation. In China, it's been less of an issue, but in parts of India, inflation has been very, very high, particularly when it comes to certain commodities. So you're talking about historical highs. Yep. All right. So those historic highs are significant, and we want to avoid that. We don't want people to endure these outrageous changes in price. And so that's sometimes why we might choose to use interest rates to moderate these shifts. Okay, a large deficit in the balance of payments. What is the balance of payments? One of those quirks. No one takes economics anymore, so I find that we cover off a bit of economics here. Yeah, that's exactly right. For all intents and purposes, it's essentially a measure of whether we're a net importer or a net exporter. And so, if we're carrying a large deficit, well, that's essentially going to be less than ideal. Okay. All right. Rapid growth in credit and debt levels. This is kind of a local issue. I think it's a very OECD specific issue, and to be frank, it's a very Australian issue. We are rather enamored with personal debt. All right, so the Reserve Bank, over the course of the last 2 years, more so than any other time in history, has talked about the need to reduce personal debt. Okay? Prior to that, you never heard the Reserve Bank really talking about this. But the reality is it's a real issue at present. Yep. Yeah, I would say it's probably even higher if you're looking at other measures of consumer credit. One of the key challenges in our market is that because we operate at the highest income to property value multiple, we operate at the worst income to property value multiple, so the lowest level of income relative to the highest value of property. Because we operate at that multiple, we need to borrow far, far more than people in other countries do relative to our income. Okay? So it's a real challenge. I mean, that is not to say that our market is overvalued, it's just the reality of our market. All right. So, what will an increase in interest rates achieve? We sometimes refer to an increase in interest rates as a tightening of monetary policy. So, if you ever watch, I don't talk about it in these terms on Australian television. If you ever watch, PBS News in North America, they'll spend a lot of time talking about monetary policy. They'll often use expressions like, we're going to be tightening monetary policy. A tightening of monetary policy essentially refers to a tightening of the economy in many respects. We're tightening our policy program because we're trying to restrict activity. We're trying to stifle economic activity. That might seem really odd. Why would you ever want to stifle economic activity? Well, here our goal is to stifle economic activity because inflation is likely to be at a level that we're not terribly comfortable with. What is the general target when it comes to inflation? It's usually 2 to 3, or actually 2 to 3.5 in most countries. When you're getting to 4%, it's starting to become, reasonably problematic for people at the fringes. The challenge of the remarkable improvement programs of China and India in recent decades has been that in many years they've exceeded 5% inflation. It's had a real, I'm not going to say deleterious, it's been really challenging for many, many people living at the fringes. The vast majority have seen their quality of life improve dramatically though, and that's the complex trade-off that occurs here. As you improve the quality of life, the many at the expense of those that are struggling, living on a subsistence existence or a subsistence type model of existence. I don't think there's any particular answer to that, but again, something to consider. All right, a decrease in the size of the current account. All right, so if we increase interest rates, we're likely to see an impact in terms of our export program as well. And we could quite possibly attract foreign investment, causing the domestic currency to appreciate. This is an interesting view to take, because some would argue that this is going to be a transient effect. It's not likely to be an enduring effect. But there is strong evidence in support of this. But those of you that have read any higher level economics textbook, would have read about covered interest rate parity theory, which says that this doesn't happen. So again, you'll find different views in different books. The answer is somewhere in the middle. Okay, when we engage in some sort of monetary policy action, it's going to give rise to some sort of effect. But the effect itself is not singular. There are multiple stages, and we need to be aware of those stages. Let's take a moment and start by discussing a monetary policy action. Governments around the world engage in their monetary policy program, generally speaking, through an independent body. So they don't actually have a direct say in what goes on within many OECD countries. We in Australia have a model very similar to the US reserve model. However, it does differ. In the US, they have a number of state reserves. And these state reserves each have effectively a president chair. The president chairs all come together and they make decisions in relation to the overall direction of the US monetary policy program. And more often than not, those decisions are made through the New York Fed. Okay? So the state Federal Reserves meet, come to some consensus view, and they choose to then buy or sell US government securities. Through buying US government securities, they essentially make available cash to the market. If they're buying securities from the market, they're essentially making cash available to the market. So in the market, there are a number of participants. Let's say for argument's sake, each of you holds a series of US bonds. At present, your money is locked into that bond. Even though it's a near cash security, your money is still locked in. If, for argument's sake, the US announces that it is engaging in an open market operation and it is making an offer to buy those bonds, it's essentially going to be making you an offer more often than not that you won't be able to refuse because it will be at a favourable rate of interest. All right, so I'll present you with this offer, and then you'll decide whether or not you're going to engage in this I'm not going to say investment program, divestiture program. All right, if you choose to all divest, all of a sudden you are now no longer in possession of the security, and the market is awash with cash. All of that cash increases the supply of money within the financial system. By increasing the supply of money in the financial system, we are reducing the price of money. It's a very odd expression. And I think I'm one of the few people that uses that expression. I think it's a really helpful one. What is the price of money? I think every economics class should be taught this way, so I don't think I'm wrong. What is the price of money?
Exchange.
Sorry?
Exchange rate.
Well, in the context of borrowing within any market, I'll offer you that category. In the context of borrowing in any market, what is the price of money? Yeah, the interest rate, all right? So that's the moderating mechanism. We increase the supply of something, we reduce its price. The price of money is the interest rate. That is what the monetary policy action is going to do in the event that a given quasi-regulatory body, the Federal Reserve, is going to make money available to you for the purchase of your securities. So that happens quite frequently. On every occasion when there is a change in the denominated rate of interest, whether they shift it up or down, there is going to be an action in the market, an open market operation. If they want to reduce rates, they're going to buy securities and make money available to the market to increase monetary supply. If, for argument's sake, they want to decrease, or my apologies, if they want to increase the rate of interest, what are they going to do? Well, if they're going to want to increase the rate of interest, they're essentially going to do what? So I've told you how they'll decrease the rate of interest. They'll decrease it by making money available to the market and taking all those securities out of the market and holding them aside. If, for argument's sake, they want to do the opposite, what would they do? Let's say, for argument's sake, we want to increase interest rates. What is the Federal Reserve going to do? Yeah, so essentially they're going to create an incentive structure such that the bonds they possess, that they make available to you, are going to appear worthwhile. You're going to acquire these bonds, and all of that cash that you possess is now going to be held outside of the formal financial system for all intents and purposes. Okay. By reducing the supply of money in the system, we're increasing the price of money. So the price of money is the interest rate. Interest rates go up, and it does happen. One of the things that most textbooks and indeed theorists will forget to mention is that they also impact the interest rate in another very important way. Banks hold deposits with Federal Reserves. The Federal Reserve decides the rate that attaches to those accounts. Okay? When they change their targeted rate, they change the rate of theirs. How does it differ in Australia? Well, in Australia, there is no state-based reserve system. We just have a national reserve bank, the Reserve Bank of Australia. They meet every month and they decide what's going to happen. All right? They essentially come together, they look at the economic climate and they make a determination. Their decision is not moderated in any way by government, albeit governments from time to time will say certain things. They will say, we don't think rates should change, we think rates should stay down. It does become a little political. The reality is the Reserve Bank still operates independent of government. All right, so when the Reserve Bank engages in a program of change, on this occasion it's a tightening of monetary policy, an increasing of rates. So if they're increasing rates, what are they doing? They are selling securities, taking that money out of the system, increasing rates if they're tightening monetary policy. Okay. What happens initially? Well, initially we observe that liquidity effect. Okay. So on this occasion, we're going to see a reduction in the quantum of funds in the market, enough to elicit the change. We're also going to see a change in the rates attaching to the bank accounts that are held with the Reserve. We then see an income effect. This is a little bit more problematic to quantify and to explain, in my view, as well. The income effect sees essentially an increase in rates, reducing spending levels and income levels. Why do you think rate increases reduce income and spending? Spending, I think, is a clear one. Yes, that's exactly right. If there is a greater incentive to save, people are incentivized to do. Equally, this is very critical, it's more expensive to borrow. All right? Credit cards become more expensive. Bank loans become more expensive. Everything becomes more expensive. But beyond that, your income level is impacted because the relative value of income is going to be impacted by virtue of the rate change. You're going to see an erosion in the value of your income. In truth, that is in part because of the inflationary impact. Okay? The inflationary impact causes your income to become a little bit less valuable. Okay? If inflation is still high, income is going to be eroded. But that effect should ease. That effect should ease. Okay? So income erosion should ease, and subsequently, when rates start to become more moderate, and indeed when the inflationary impact in particular starts to decline, we're going to see that impact ease and become much less significant. All right. The final impact, and the one that we're after, the one that we're actively pursuing, is an inflationary effect. We want to see the rate of inflation decline, such that it falls within our targeted band of 2 to 3%. And that's generally why we engage in a monetary policy program in the first place. All right, so this is just a diagram that tries to quantify things. The reality is you can't isolate these effects. Okay, no one can isolate these effects. It's just a visualization. All right, no one can honestly say, well, this is just the income effect, this is just the liquidity effect. It's an impossible exercise. All right, so it's difficult to forecast the extent of each effect, particularly through complex changes in the business cycle. But that doesn't mean that we don't try. Okay? We still endeavour to. But generally speaking, we focus the majority of our attention on looking at other indicators. Why do we devote so much attention to looking at other indicators when trying to engage in a forecasting process? Well, truth be told, it's important to understand what's happening within the economy, and indeed, it's important to try to map the associations between key indicators, because frequently, when we're focused on something, a particular metric, We can only analyse what's happened after the fact, after something has occurred, after a change has been elicited. It's kind of unhelpful. Anyone can say that they were correct after the fact. It's kind of useless being correct after the fact. You want to be correct before something is happening. You want to be able to forecast changes and impacts before they occur. And to do that, quite frequently, we use economic indicators that we describe as lead indicators. These indicators are a good way to measure the performance of subsequent metrics and measures of focus. So in the context of economic production, there are a number of indicators that we use to try to analyse what is likely to happen in the subsequent quarter or subsequent year, for argument's sake, in relation to economic production. What are some indicators that you think are particularly compelling or useful when it comes to commenting on the future, commenting on the likely position or state of the economy in economic production terms? What are some things that you look at when you try to comment on how the economy is going to perform in the future? Because I'm guessing everyone does this, even if you do it implicitly, even if you do it indirectly, or even if there's some sort of, how do I put it, subconscious, non-reflective exercise going on. Almost everyone does think about these things. How do you think most people engage in this kind of analysis? Well, the reality is, even if you don't think people do this, they do. People's spending behaviour and savings behaviour usually reflects an implicit forecast in relation to what's going to happen in the future with respect to both their own income level and the broader economy. How do you think people formulate these views? Yeah. Yeah, so GDP is what we're focused on. What types of things might we look at if we're trying to understand how GDP is going to change? So GDP is our focus. What indicators will help us predict what will happen to GDP? In relation to, in a broad sense? Okay.
Price of oil back in 1973 went up, and so caused inflation for our economies.
Okay.
GDP
Okay. So if the costs of production go up, we're likely to see an impact to the level of production. Most certainly, yeah. The unemployment rate is an excellent one. All right. The unemployment rate speaks to a number of things. You tell me what information you can glean from the unemployment rate. What is it actually speaking to? Because it's important that when we look at the unemployment rate, we understand that the unemployment rate reflects not just current employment needs, quite frequently it reflects employment need to an extent in the future. But there is a slightly better measure that relates to employment as well. Sorry? Per capita income is a very, very useful measure, but it tends to be more of a coincident measure. So that means it tends to reflect the economic conditions of the day, and to an extent, the economic conditions of the future. So it is a bit of an indicator, but it's also very much a coincident indicator. But it is one of the indicators that we look at, so thank you. What is another way to look at employment? You'll frequently, if you watch PBS in North America, they will make reference to this. We don't really make reference to it as much, but Westpac and the CBA offer indexes in relation to these measures. Job creation. Job creation. Why do you think job creation is such an important measure? Yeah, and it speaks to what I'm doing in the future. If I'm in a position of economic leadership within an organisation, I'm recruiting people because I need them now and into the future. All right, so the job creation numbers speak to what is going to happen, my scheduled production. Okay, what is another associated measure then? So we talked about the joblessness rate. talked about job creation, we've talked about GAI, or per capita income, all very useful lead/coincident indicators. But there's one that I think is particularly compelling, okay, that we don't devote enough attention to, and that is business sentiment. Okay, business sentiment measures are important even if they're not correct. Why are they important even if they're not correct? Sorry? That's exactly right. How business feels matters in some respects even more than consumer sentiment, because business leaders and those engaged in any process relating to business purchasing, so those involved in any sort of spending activity involved in business, the sentiment that they hold matters, because that sentiment reflects how they will engage in purchasing and spending. So that often is one of the best indicators. Business current and future capital spending and business sentiment. Current and future capital spending within business and business sentiment. You look at those two measures and you understand what the economy is going to do. Because they choose not to spend. It doesn't matter if general economic conditions do improve, the money hasn't been spent to generate new production. Okay? So very, very good lead indicators. What are some other indicators that we tend to look at? What are some good coincident indicators? So one was mentioned, income level. What are some good indicators of what's happening right now? Because we can't measure economic production on an intraday basis, can we? What are some things that we can look at? Sorry? That's exactly right. So investments at a very, very high level we can look at. We can look at past FDR, current FDR, intra-quarter FDR, but in particular, what investments should we be looking at? Yes, exactly right.
Individual and the government income and expenditure, on the basis of that, how much investments the government makes outside the country?
Yeah, so government investment is a really, really good indicator, but it's a really simple one in many respects. Just looking at the performance of the market, looking at the ASX, that speaks volumes to where we are right now. It's an imperfect measure because the reality is within global markets and globalized markets in particular, everyone's performance affects everybody else's. And so in modern times, this kind of analysis is far harder by virtue of the fact that there are so many confounding influences. But hopefully that gives you a broad capture of the kind of metrics that you should be looking at. And those of you who do 760 with me in the future, we're going to actually build regression models and maybe even some machine learning based models to actually look at how we can use those numbers to try to predict what's going to happen. Okay? In this course, we really just sort of focus on looking at averages, looking at points of inflection and points of change, and using those as the impetus for decision making. All right, so lead, coincident, lagging indicators. Try to remember the terminology if you can, because it's really helpful when explaining how you interpret the indicator. Is the indicator leading, coincident, or lagging? All right. This is probably noteworthy. So some measures do change. So rates of change in money measures were once lead indicators, they're now lag indicators or coincident indicators. Because the markets are when it comes to many of these money market instruments. All right. So we are now going to do a little bit of theory. This course is a very applied course for the most part, but there is some theory I'm required to teach you. So this week we're going to be learning 4 theories. Okay? Why are they compelling? Because they serve as your starting point. If nothing else, as I said, you'll be an eloquent dinner party conversationalist, having known and learnt all of these things. But the truth, to be told, and I emphasise it, I've said that on a couple of occasions, this stuff is important because it is actually a very, very worthwhile starting point if you're new to this material. Yes, once you get comfortable with it, we jump straight into forecasting, formulation, model development, undeniably. But if you don't have good fundamentals and a good foundation, that can be challenging too. A couple of things to mention. 2 of the theories that we cover off on today were actually developed by Nobel theorists. And so that's kind of cool, right? It's really hard to win a Nobel Prize. More often than not, you have to do something reasonably compelling. And so, even though these theories are remarkably simple, they serve as the basis for a body of work that resulted in those theorists winning Nobel Prizes. So, if nothing else, hey, got to learn some of the work of major Nobel Prize winners from bygone eras. All right, so let's start with the loanable funds approach to interest rate determination. The loanable funds approach to interest rate determination is the closest framework that we have to a traditional supply and demand model. In fact, it is a traditional supply and demand model in my view. If this course was taught 30 years ago, we would describe it as the economics of finance, or a course in financial economics. All right. The reality is, we call it finance now because finance is a very substantial independent discipline, but this theory is very much general economic theory. If you've done some supply and demand modelling before, it's going to be pretty straightforward. All right, so the loanable funds theory of interest rates asserts that the interest rate that you observe in the market exists at the intersection of the supply of funds and the demand of funds, the demand function and the supply function. So in the simplest sense, just a supply curve and just a demand curve. What makes it a little bit quirky? Well, loanable funds theory asserts that, yes, the demand curve is traditionally downward sloping, the supply curve is traditionally upward sloping, but there is a degree of complexity in relation to how those curves are depicted. All right. Supply is said to be a function of consumer supply. Okay. So household supply in particular, changes in monetary supply, and hoarding or dishoarding behaviour. More on that in a moment. Demand is a function of government demand and business demand. This is the quirky aspect of it. Government demand is assumed to be inelastic. What do I mean when I use the expression inelastic? Sorry? That's exactly right. It's kind of a slightly unnecessary way of describing something that doesn't really change that much. Okay? Government demand is inelastic, but business demand is not. So what you're doing is combining an inelastic curve, straight line, vertical line, with a downward sloping demand curve. So your result is a kinked curve. Okay? So business, government, a combination of business and government. That is our first curve. When it comes to supply, as I mentioned, supply is a function of the money that you make available, household supply, changes in monetary supply, so monetary policy, and finally hoarding and dishoarding behaviour. So, this is a little bit challenging to construct from time to time as well. The key thing to remember is that all I'm doing here is accounting for each of them. I'm accounting for business, I'm accounting for government, I'm accounting for households, I'm accounting for monetary supply, and then finally I'm accounting for hoarding or dishoarding. All right. The effects of traditional supply and changes in monetary supply I think are pretty obvious. You have a traditional upward sloping supply curve, but then we just shift the curve depending upon whether or not the change in monetary supply reduces the amount of money in the market or increases the amount of money in the market. We then account for hoarding and dishoarding behaviour. We have one critical point of indifference. Okay? Above that point of indifference, people will dishoard money. What is dishoarding? Sorry? So, hoarding is the process of keeping money outside of the formal financial system, keeping it in cash form and holding it outside of the system, or I must acknowledge also, keeping it in grain and more inappropriate markets. All right? When yields are low, people do more inappropriate things. This is known, all right? So when yields are low, people chase yield. Sometimes that involves them engaging with inappropriate and inapt markets. Sometimes it just involves them not really caring about the incentives in traditional markets and holding money outside the formal system. The simple analogy I like to use is of like, a grandmother, keeping large amounts of cash. I could recall even my elderly grandmother taking her to the bank to withdraw cash because she believed everything needed to be done that way. She came from a country where that's how things were done. All right? It didn't matter that I was a lecturer in econometrics or finance. That was how you do things. All right? Many people still live that way, and in many countries this effect is even greater. Okay? India and China, huge levels of monetary hoarding, holding money outside of the formal financial system, holding money in grey markets, getting yield from other market opportunities. It happens a lot. What has India done in recent times to reduce the amount of hoarding? See, everyone knows. Everyone knows. Because everyone did it, didn't they? Sorry? No, you didn't go to the bank. No one went to the bank? Sorry? Yeah, but so it's funny because back in the day when you talk about this, people would say, no, it doesn't really happen. Like a lot of students go, this doesn't happen. Okay, there is no hoarding and dishoarding effect. This is a waste of time. And it's kind of quirky because we've now seen one of the most populous nations in the world enact a policy for this specific reason. All right? And everyone was really angry about it for a while. But I saw the footage of people frantically running around to banks. But technically, the demonetisation program allowed people to convert their money into a bank hold. The problem was that if you somehow came up with several thousand crores, it's kind of hard to explain where that came from. So that was problematic for many people, and some people did lose some money. Does anyone know why else we try to discourage this behaviour? It's the same reason that the demonetisation program is enacted, because people do a lot of unlawful stuff. Okay. No, I think that in some systems people had traditionally not held all of their wealth in investment securities. So in India and in China, it is popular to hold wealth outside of the formal financial system and not necessarily always garner yield on it. In India, it's also very popular to hold wealth in the form of gold. It's very, very popular for people to hold gold as well. Just a cultural. Yeah, it's the same sort of thing. So part of it is to do with, I guess, to an extent, a lack of trust in formal systems. But part of it is to do with, people doing things that they shouldn't be doing as well. So, anyway, so we've got a nice case study now. What happened in India is a really good example of trying to actively discourage hoarding behaviour. All right? So when you try to remember this, think of that example. All right? How do we reconstruct the curves under exam conditions? Government is inelastic. Business is traditional, so we just have a kinked curve. We then account for household supply, changes in monetary supply, and the one that you'll never forget, hoarding or dishoarding behaviour, adjustments in supply as a result of incentives. This doesn't just happen in India and China either. Let it be known, in North America, when yields are low, people do engage in inappropriate behaviour there too. They chase yield. Okay? Chasing yield will either involve them chasing more speculative investment opportunities or potentially engaging in other behaviours. Gambling is another example. Okay? I can show you some of my research on the impact of fiscal stimulus activities, changes in interest rates on gambling behaviour. It has an effect. One of the studies that I published recently was a little bit in the media, looked at the impact of our 2008 fiscal stimulus program. There was a $37 million spike in gambling on the day the fiscal stimulus program happened. Okay, so the reality is a few people went down to their local and put their money into an electronic poker machine. All right? So incentives don't always exist and operate in the same way for all people. All right. So that is what you need to be able to reconstruct if you get a theory question on this, okay? You can respond to a theory question in a qualitative way, using words, but it's much harder. Draw the diagram, just explain what's happening. It's much harder to write an essay on this. Monetary supply. Well, I guess the goal is to kind of account for the hoarding and dishoarding effect. It's just for economic elucidation. The reality is the final curve is the correct curve. Yeah, it's kind of the stages effect. So in truth, I mean, that's probably actually a valid point. You only really need to depict the final set of curves. When doing this, you see, you know, explain. So explain what's going on with each of the curves. Okay. I'm required to teach you this theory to you, so you know, because technically speaking, this is the unit that's supposed to prepare you for, I haven't told you this, but it's supposed to prepare you for writing for all your own courses. So one of the things that we, sorry, please?
Yeah, this one, does it, you said the money or is held out of the financial system. So at some point of the time, it will come back in the financial system, right?
Which money?
This whole money, which is kept. If the cash is kept at home, so that money will, at some point of the time, it will be spent on something and it will return to the financial system.
I agree with you, but what we're doing is measuring it in aggregate. So that means that those frictions that you're referring to, those actions, when someone engages in a hoarding action and then his source by returning the money to the system is matched by the incentive to work with other people engaging in the corresponding hoarding behaviour. So in aggregate, when rates are low, people hoard much, much more in aggregate. Yeah. Individuals will obviously engage in unique behaviours and hoard and disorder depending on their needs, but in aggregate, when rates are low, people do keep money outside the formal financial system. Think about it this way. Look at the incentives that present for putting money into our formal financial system in Australia. What are you guys getting on your standard transactional accounts? Not even passports. Let's say you've got your money in a cash management trust right now. I'm not talking about investing in like Australian super or investing in uni super or something, you know, like they're presenting different returns because they're investing in very different things. They're just a traditional cash. Yeah, 2% at best. You know, that's kind of what's on offer. And so for many people, it's kind of like, does it really matter? Should I really bother? I think that's a really poor attitude. I think everyone should be doing the right thing and putting it into a bank account, but when rates are low, people tend to not care as much, unfortunately. It's a real problem in a number of European countries as well. So in Greece, the level of tax receiving and the depository rate is very, very poor. It's one of the reasons they've got so many economic issues. When your savings rate is low, when you hoard money outside the financial system, and you remit limited amounts of tax, you essentially tie the hands of government. Government has low tax remittance. It's not going to be transactional tax benefits. It's happening outside the system, and all of a sudden the economy struggles to function. All right, so this is an example of a yield curve from a bygone era. Okay, the reason we use this one is because if we use the yield curve from post-2010, what would it look like? That's exactly right. You're doing the course at a very exciting time in history, where yield curves around the world almost all look the same and they're all remarkably flat. Why is that? You all know the answer, the humans bring it. Why are they so flat?
Because one explanation would be there has to be the growth in wages,
Wage growth, yeah, there's certainly some truth to what you're saying there that has played a role, but why do you think the reserves around the world, the central banks, so in India, the Indian central bank, setting in the US, the Federal Reserve model, why have they chosen to keep rates so low? In Japan, for example, the Ministry of Finance and the Central Reserve Authority, why have they chosen to keep rates so low?
Because they want the customers to spend more.
So that's exactly right. And so how would we describe that? We would say they're trying to do what? What are they trying to do?
But they think
That's exactly right. They're trying to stimulate economic activity. Is it working?
to an extent.
Yeah, I would say it really depends on the country that you're looking at present. The vast majority of countries in the OECD are not really growing at a rate of knots. If you're looking at Brazil, Russia, India, and China, well, it's a very, very different situation. We in Australia kind of fall somewhere in the middle. Okay, a little bit of history for you guys. This might come as a surprise to some, but we would be third best performed economy in the OECD during the GFC. Okay, so I'm not going to put any political cap on, but let's be clear, that's pretty good. Okay? Our fiscal stimulus program was also one of the largest, let that be known. So, South Korea and Australia, on a per capita basis, put more into their economies during the GFC than practically anybody else in the world. And our economy has been reasonably resilient, which is why our yield structure is a little bit more elevated than the yield structures in other countries. How has Japan performed? Let's be clear, Japan's a remarkably innovative country. Remarkable when it comes to what they've been able to achieve. But how have they performed in this context? Yeah, so why are yields effectively negative in Japan? Can I ask you, what do you think your colleague means when she refers to yields being negative in Japan? Are they really are the yields quoted in nominal rates on bank statements negative? Or is it something else? What does the real rate being negative actually mean?
It's got something to do with stagflation, which is inflation in the economy that's not really growing at the same time.
Yeah, so undeniably stagflation has been an issue, a little bit beyond scope in terms of their recent issues and the broader unit, but undeniably stagflation is relevant. So they've had periods of hyperinflation and stagflation where inflation pressures have been incredibly onerous, but they've not really been in a position to do anything other than seek to stimulate the economy by virtue of other economic needs and wants. But one of the most critical reasons is simply what?
The flow of currency is not considerable to an extent.
The time period for which the loan is borrowed, it's like they allow home loans to be borrowed for 100 years. Up to 100 years.
Loan structures have played a part, but look, to be frank, one of the key reasons is really simple. They need to stimulate their economy. And unfortunately, they've gotten to a point at which rates are now at historic lows. And if we account for the cost of inflation, when looking at their nominal rates, the cost of inflation in Japan exceeds the nominal rate, which means that everyone is losing value through time. Okay, so the real rate of interest, which is the rate of interest when you account for inflation, is actually negative in Japan. Okay. That doesn't mean that the quoted rate is negative, it just simply means that if, for argument's sake, the quoted interest rate is 200 basis points, 2%, and the rate of inflation is 3%, you're actually losing 1% every time. All right. Oh, okay. So, I guess this curve is probably representative of an economy that's gone through a couple of ebbs and flows. You can see that rates are initially very, very low, but the rate environment and rates have gone up. Rates have gone up in this situation, most likely in response to an increase in inflationary pressure, because the economy has been performing well, and and there has been a need to slow the economy to an extent. The Treasury bond rate tends to correspond very, very well with the cash rate. Logically, you would assume that it would be incredibly close, if not identical. Okay? Then we've seen the need for a reduction in rates with a view to stimulate the economy. This is a conceptual diagram, but it does really speak to what's happened in Australia. We were talking, Ron and I were talking about Australia in the 80s and 90s. Has anyone looked at the yield data relating to Australia in the 80s and 90s? What happened here then? Yes, so most of our textbooks only focus on recent decades. We should probably look a little bit further back. But what happened during the 80s and 90s and early 2000s? How were rates at those points in history? How is perhaps an inadequate word. At what position were rates at those points in history? Incredibly high. And so can you recall what some of the highest rates were that you observed?
I looked at 15%, 17%, also the real estate at the time, and once the rates went up to 16%, couldn't get it. No one was so, yeah, it was the beginning of the downturn.
Yeah, so in Australia it was rather quirky, almost the opposite position to the position that we're in now. Rates were outrageously high, relatively speaking, in part because of the Asian financial crisis. And many people like to ascribe much of this to the Keating government, the Hawke Keating government to an extent, but the reality was we were coming out of the Asian financial crisis, and the rate environment generally was very, very high. The point of difference, though, when it comes to consumer credit and borrowing generally, was that people generally had mortgage values of around what amount? What was the average mortgage? The average is probably inaccurate. The average is probably inaccurate. What was the median mortgage value? It's quite a large window, so I can see if people don't remember. Yeah, so depending on the suburb that you were looking at, between $60,000 and $100,000. So even though rates were very, very high, the capital value of which the rates were attached or signed was much, much lower. So people do talk about the difficulty of that time and the mortgage stress that people endured, but in truth, mortgage stress is much, much greater now. All right. I might next week actually bring in the actual yield data and we can go through it in Excel. All right, so when we describe yield curves, we normally use the following terminology, the following expressions. This is just for interest's sake. Normal positive, inverse negative, or transitional. Okay? So normal positive, inverse negative, or a transitional curve. I think the terminology is helpful, but sometimes it belies the complexity of what's going on. Okay? The following three theories are the other key theories that you need to remember from this week that are within the scope of your assessment. Okay? Once we've covered off on those, we're then going to do all of our fun financial maths relating to geometric averages and implicit rate calculations. All right, so we're going to start by having a look at three key theories of interest rates. Most of the financial maths that we do is based around expectations theory. All right, so when we build models, even complex regression models, they still tend to be founded in some sort of underlying framework or theory. We tend to focus on expectations theory to an extent, segmentation theory, but generally speaking, expectations theory is our starting point. Why is it our starting point? It's going to sound really terrible. Many of the models that are incredibly popular in finance serve as a starting point, even in contemporary modelling at a very high level, because they're conceptually simple. Okay? That's actually what the last textbook used to say. We use this model because it's conceptually simple. I don't think anything should ever be used for that reason. But because of the popularity of the approach, it almost becomes built into the market. In truth, it is actually a useful starting point beyond being conceptually simple, because it actually explains the relationship between rates in compounding terms. It looks at how one rate interval impacts another rate interval and then counts the time. That's why I personally think it's a compelling starting point, not just because it's conceptually simple. When you get into the real world, you'll discover that when it comes to actually modelling impacts and effects, we don't use this model beyond using it as the basis for ex post calculations, reviewing what's happened within an underlying market, or to present or offer an interval rate. When it comes to genuine and legitimate forecasting, we do tend to move well beyond the basics of this. All right. The great thing about these theories is that if you remember the name, you will remember the theory. Most students don't encounter great difficulty with this, but it does present challenges from time to time because there are a few key elements. As the name would suggest, expectation theory is based around this simple notion, this simple fact, that current short-term expectations and our knowledge of the future, our expectations in relation to the future, govern the shape and slope of the yield curve. So current short-term rates and our expectations in relation to future short-term rates govern the shape and slope of the yield curve. What does that actually mean in a practical sense? Well, it means that investors know current rates and they have relatively homogeneous expectations about what will happen in 6 months' time, in 1 year's time, 2 years' time, so on and so forth. So they have homogeneous expectations. The other critical requirement of this theory is that there are no transaction costs and market impediments. We can adjust it to reflect them. But the core theory, the original Nobel Prize-winning theory, is based around this notion of an absence of transaction costs and market impediments. And finally, this is a very important one, investors view all investment opportunities as perfect substitutes, regardless of maturity. And we already know that different investors have different attitudes to different maturity terms and structures. So that assumption is a slightly flawed one, but it serves as the basis for the initial theory. All right. So, let's try to validate the theory momentarily. Let's sort of look at whether it's worthwhile. What do people think will happen to rates in this country over the course of the next 6 months? How many people think rates will go up? Show of hands. Rates going up in the next 6 months? Rates going down in the next 6 months? Rates staying the same over the next 6 months? Yeah, I'm in that group. A number of you didn't put your hand up at all. I'm not sure what that reflects, to be frank, but some sort of meta-level understanding of markets that we're not going to get into now. Something that's sort of transcendent that's going to happen. All right, so how do you remember it? It is complex to remember, but the critical thing to remember is that current short-term expectations and our knowledge of future rates govern the shape and slope of the yield curve. We all have generally homogeneous expectations. Normally when I do the question of that time, the expectations is generally homogeneous. It didn't quite work that time. But generally, we do have fairly consistent assumptions about the future. And finally, rather limiting assumption, we assume investments to be perfect substitutes. Why is this perfect substitutability requirement an important one but a naive one? Well, it's important because if we don't move into perfect substitutes, we will have preferences in terms of the yield structure. You might choose to invest more medium term or more long term. Okay? It's naive for that reason, because generally people do have preferences. People, when they're younger, generally speaking, do tend to invest short-term far more. Beyond that, firms invest differently too. If you're a hedge fund, you're going to be investing very, very differently in terms of both risk and term of investment when they're contrasted with, for argument's sake, a general insurer. By definition, your investments will be different. You're going to have term preferences. All right, so this is the basic equation. It gets a little bit more complicated than this, but we'll start here. So this is a useful starting point when it comes to learning notation. All right, because the notation is important. It's one of the few things that you will need to know when it comes to syntax and logic in the final paper. You will need to know this notation. So here we have an example. The rate on a 1-year instrument is
7% per annum, the investor expects to obtain a 9% per annum rate of return on a one-year investment starting in 1 year's time. What is the current 2-year rate? Well, on the CFA exam, this is a question from CFA. On the CFA exam, you just do a simple arithmetic calculation like this. Okay? Obviously, in reality, every rate will be on every other rate. So we do it as a geometric average, not as a simple arithmetic average. Okay? But this should teach you the logic. It's simply going to be one rate plus the other rate divided by 2. Okay. So what is our notation? What does the 0 denote? What does the I denote? What does the 2 denote? The 0, that first number in our notational structure, denotes the starting point in terms of that rate of quotation. So it's a current rate. If you see a 0 value, that means that it's a current rate. 0 is today. The second number, the 2, denotes the term of the rate. So the first number is the starting point. The second number is the term of the rate. So if it was 0I5, it would be the current 5-year rate. If it was 1I7, it would be the 7-year rate in 1 year's time. Okay, so the first number is the starting point. The second number is the term. Okay? How does expectations theory explain the shape of the yield curve? Well, it does so very, very easily. Inverse rates simply reflect the fact that future short-term rates are going to be lower than current short-term rates. So our modulus expectations about the future suggests that rates will go down. A normal yield curve suggests that short-term rates will be, future short-term rates will be higher than current short-term rates, simply because we envisage that our modulus expectations reflect that we think short-term rates will be higher in the future. And a transitional curve simply reflects that fact. The fact that we're transitioning to higher rates in the short term, but then transitioning down to lower rates thereafter, based on expectations. What does segmented market theory suggest? Okay. I should actually say market segmentation theory. That's my fault. Segmented market theory is actually 18th century Keynesian economics. The words sound very similar, and I, for some odd reason, wrote segmented markets. I should say market segmentation. Sorry?
Portfolios.
In this case, no, it's much simpler than that. It's simply just like a supply and demand theory. So market segmentation theory contends that there are different subsegments within the market, and there are participants in those subsegments that are active in those segments and only those segments. So for argument's sake, market segmentation theory would contend that there are some people that are going to invest short term, some people that are going to invest medium, and some people that are going to invest long term. And the supply and demand preferences in the short, medium, and long term market will reflect those points. Well, I can remember reading these original papers back in the day and thinking, well, what about the lack of synchronicity, connectivity within the curve? How do you think we account for all of the gaps in the curve if there are only a handful of defined segments or terms? What do you think happens? Very simple and eloquent answer. People ride the known curve into the next segment. What do I mean when I say that? Well, if for argument's sake you're a 1-year investor, some might take that to mean that you can only invest in the short end of the curve. Okay? Investing short term. That's not necessarily true. An astute 1-year investor might choose to invest long term, but carry the asset only for a limited portion of the investment term, and then sell it into a different segment. Okay? So we account for the separation in the curves by acknowledging that some investors will still invest for their investment term, but during a different maturity term in terms of the overall. So, 1-year investor wants to carry an investment for a relatively short period of time. He might invest in a 2-year asset, then carry it for just over a year, and then sell it into the 1-year market. Okay. He still has the same carrying term that he wants, but he generates a higher return. Some people describe that as bootstrapping. It's more correctly described as riding the curve, riding the yield curve. Okay. All right. Oh, look, that's probably worth talking about briefly. So, expectations theory contends that there are no arbitrage or asset shifting opportunities. Okay? No arbitrage, no asset shifting opportunities. So, with pure expectation theory, you will generate the same return investing 1 year and then investing for a following year. The same return will be generated from that investment structure as would be generated from a 2-year investment. So you can invest, for argument's sake, 5 times for 1 year, 5 1-year investments, or you can invest for 5 years. You are indifferent between the two because there is no arbitrage opportunity. Segmented markets theory, or more correctly, market segmentation theory, contends that there are, in fact, opportunities for speculation and arbitrage. Okay, the final theory that we're going to be learning today is liquidity preference theory. This theory asserts that investors prefer short-term instruments to long-term instruments. Do you think this to be true? This is called making expectations theory more useful. In truth, that is all we're doing. We're making expectations theory more useful. This theory simply extends upon the standard expectation theory to make it more realistic, more pragmatic. We can make further adjustments to make it even more realistic and more pragmatic, but this is the only one that we do in this course. We argue that even absent of any other shift or change, investors will always have a preference to liquidity, because liquidity also reflects risk. So the shorter the investment, the less risky the investment will be. And they require greater compensation for lost consumption and greater risk. If they invest longer, they require greater compensation for lost consumption and lost risk. You might recall that example I presented involving Centro Property Group and their process of investing using medium-term funds for long-term assets. They did that because medium-term funds were cheaper than long-term funds. It's frequently the case that we observe a normal positive curve. It's frequently the case that we observe a yield structure where short-term rates are much lower than long-term rates. Okay? That's because of the preference to liquidity. So try to remember that. This is just an extension of the standard theory. We just add an additional parameter plus L to account for the liquidity premium. So what does it do? The liquidity premium makes positive curves more positive. It makes inverse curves less inverse. Okay? It makes a positive curve more positive, it accentuates the positive curve, but it diminishes the inverse curve. And this, I think, is very true of what we observe in markets. Have a look at some of the empirics around this. Right? I think you'll find it to be a pretty comfortable extension of the standard theory. Okay. So a couple of things to note in relation to risk. Hold on 1 second. I might just determine how many slides we have. For some reason, I don't have the count in here. I'll get through these remaining slides and then we'll have a break. Rather than giving you a break now, just for continuity purposes, we'll finish off this set and then you guys will have a break. And then we'll come back and do some questions. All right. So on the matter of risk, it's important to appreciate the different instruments will have different risk structures. All right? We generally use the shortest treasury instrument as our proxy of a risk-free investment. Okay, so frequently in Australia we use the T-note rate as our proxy of the risk-free rate, or even the T-bond rate quite frequently, even though it's a longer rate. Why? Because sovereign risk in Australia is very low. We have the third best rating in the entire OECD. Third or fourth. That's pretty good. All right. What does that actually mean when I use that expression? We have in Australia the third best rating. That's exactly right. Our credit rating. A credit rating reflects the likelihood of default or if you want to sort of flip it the other way, the probability of loan performance with respect to a given offering, more often than not. In the context of sovereign risk, a number of key factors are taken into consideration. We sit at one end of the spectrum. There are a number of economies within the Eurozone that sit closer to the other end of that spectrum because their credit metrics are not as good as ours. There are national level ratings. There are also state level ratings. Who do you think has a better rating? This is me being a bit parochial. Who do you think has a better rating? Let's say for argument's sake, New South Wales or Victoria? Who has a better credit rating? Victoria does. You made a good choice. Okay? I'm not going to fall apart while you're saying it. No, the New South Wales rating is also very, very good. It's an exceptional rating, but it's not quite as good as ours. One of the reasons that is purported to be the underlying causation for the revision of rating was the sale process relating to some of their utilities and also some of the, again, for lack of a better description, the poor decision-making relating to economic productivity and infrastructure investment. In the view, supposedly, of ratings agencies. But in saying that, the rating is still exemplary. Our state-based ratings in Australia are all exemplary. Victoria has the best rating, okay, overall. If you also look at the credit commentaries and overall ratings, yes, we have the best rating, but all states in Australia have exemplary ratings. Beyond sovereign ratings and state-level ratings, corporate debt is also rated. Okay? Corporate debt is also rated, and you'll find that corporate ratings models differ, but the methodology, broadly speaking, is largely the same. So you'll find some ratings methodologies move from a D- model through to a AAA. Others might use an alternative rating representation like a triple D to represent one end of the spectrum and a AAA at the other end. But the reality is they're all very, very similar. What are they all trying to do? They're trying to provide you guys with a mechanism through which you can capture a substantial amount of information about a company with respect to its underlying risk. So they're essentially providing information to you that supports your decision making. It's important in the context of the information economy. They provide a very important role. But we do place a lot of reliance on their ratings, and you might recall from Rahul's presentation last week that many rather, I'm not going to say foolishly, I'll simply say naively, place such weight on these ratings, such a credence to these ratings, that they believe that a AAA rating meant, for all intents and purposes, that there was zero potential for default. But the reality is, these ratings do not reflect such likelihoods and confidence levels. They're a broad capture of risk. They're not perfect, but if you look at the underlying data, AAA rated securities have made payment 99.999% of the time. It's pretty high. Problem is when they don't. When it becomes a problem. People often talk about the GFC as being a black swan type event. I personally don't think that it was. The reality is property markets always falter. Okay? Some AAA rated securities in certain commercial grades, in the commercial grading of AAA, have defaulted at higher rates than 99.9, sure. Much higher. All right. It's important to appreciate their role, but they're not perfect, and they're certainly not to blame for all mistakes either. I mean, there needs to be some judicious consideration of the rate itself. There needs to be some sort of broad review. The rating that attaches to a securities tranche will generally determine the rate of interest that attaches to the securities tranche. So once a rating occurs, an instrument is priced and released into the market and is bought and sold. But ratings do migrate. For those of you that are interested, I can send you a copy of the paper that I have published recently that uses artificial intelligence models to predict ratings migration. We get about between an 87 and 93% accuracy level, generally speaking, when it comes to ratings position and ratings migration. The reality is you can explain a lot of the underlying movement. Okay? Sometimes it is still unpredictable, though. It is still challenging to account for all variation. But if you can predict this movement, it can be very profitable for you. The idea is that you try to predict when a security will improve its rating, or the rating will become poorer, and you short the security for argument's sake and generate an economic rent, an economic return. Right? So, triple B. Triple B is actually considered investment grade only in one country in the world. And that's the US. And the US is the largest and most significant player when it comes to corporate debt. There is far more trade in corporate debt there than anywhere else in the world. Does anyone remember the movie The Wedding Singer? The Wedding Singer. All right, this will help you remember all of this, I'm sure. In the movie The Wedding Singer, Adam Sandler plays a wedding singer, right? Everyone? All right. Does anyone remember what Glenn, his rival in the movie, does? What job does Glenn do? You want to remember? The guy that gives her the CD player. So, what does he do? Why do I try to do this? Make popular culture references. All right, Glenn is a bond trader. He's a junk bond trader. He uses the expression junk bond. Okay? A junk bond is a bond that is rated less than triple B. Okay? In the US, there are a huge number of people that trade in junk bonds. In truth, they're not really junk. They're very valuable. They're lower rated securities that present a return of between 15 and 25% on average. It's not junk, but the default rate is much, much higher. The default rate is much, much higher than other junk bonds. Okay? Which is why some people refer to them as junk bonds. They're actually correctly described as lower than investment grade bonds. All right? But I like the movie because it's the only time I've ever seen someone talk about bonds in a movie. The Wedding Singer provides financial services education. All right. Look, they do in Wall Street, but to be honest with you, I mean, that's largely contextual. And how many people watch movies like The Wall Street compared to The Wedding Singer? So it's a fair chasm in terms of the separation. All right, well now, the next time you watch The Wedding Singer, I want you to look at that scene where he talks about what he does. And then, like 5 minutes later, Adam Sandler talks about becoming a junk bond trader. All right, moving on. There is one segment of the market that is worth talking about, albeit briefly, that is different to all of the others, and that is the market for ultra-high-risk, short-term borrowing. The market for ultra-high-risk, short-term borrowing presents a different yield structure. Some people use the term mezzanine to describe this market. Has anyone heard that expression called mezzanine finance? Mezzanine finance is sometimes described as bridging or ultra short-term finance. In this market, you will see the shortest end of the curve presenting some of the highest yields that you will see in any other market. Why? A couple of reasons. Mezzanine finance is presented to people, generally, that are close to project completion but have run out of funding. For that reason, they're generally not in a position to negotiate substantially. The other key reason is that the funding is generally provided for a very short interval. Okay? And so, this curve is different to all others. Very, very high at one end, but as the term becomes longer, the yield actually becomes lower. And that's because medium-term mezzanine finance is generally provided to firms that have more assurity and more underlying capital. You wouldn't give them the money if you didn't trust them medium-term. Okay? So the mezzanine finance category is the one category that differs from all of the others. And not just mezzanine, any ultra short-term high-risk lending. All right, that is the extent of what I wanted to discuss in terms of theory and application at this point. We'll have a short break and then we're going to do a lot of calculations relating to implicit rates. Okay? So we'll go through the notation again, we'll go through some simple examples, and then we'll go through some slightly more complicated examples. I'll see you guys back here in about 10 minutes. If you have any questions or concerns about anything you'd like to talk to me about over the interval, pop over and say hello. How you going, Ron? You good? That's okay. Pick one or you can pick your own if you like. You can pick one or your own if you like. discussion with you. Yeah. So you don't have to pick one of those. I just gave them a set of ideas. So if you have, I mean, you want to do something property related, maybe, I don't know. That could be something, could be a thought. There's one question on negative gearing that I thought would be well suited to you. It's up to you. Yeah, I'll go through them with you afterward if you want. No problem. I'll be. Down that way? I'll be back. Yeah, it is. I can meet on Wednesday. The only break I have. I have break 3 to 4 on Wednesday. Still weekend. On break, so we can building LB. Your building, yeah, there's like a few courtyard, there's only one cafe. Yeah, only because I have class, I have a lecture directly. Go over the walkway, over the main walkway, and just to your left, just over the bridge. Yes. That what? Alright, so I'll see you there 3 to 4. Alright, sorted. What was your other side? Want a couple of books I can use? Email them, I'll send you some. I can send you some stuff. Cool, I'll send you some stuff. Oh, so there's 2 chapters. I believe the next one is chapter 1, and the other is chapter 6. But if you come up with fast, I can show you. I put together a list of the shortest available for people who just want to read those sections. But if you read those chapters fully, that would be the best. It's like 50 pages. So what I would say, most of the chapters correspond to government structure, policy, and system. So you can read that one. That would be good. Or you can read, there's another one that's a little bit more economic. That's an introduction, full introduction to market policy. They both cover the same things. There's actually 2 chapters that cover the same thing in slightly different ways. So chapter 17 is more of the economic theory, and the memory chapter 10 is a little bit more finance. Whichever one is easier for you to kind of get by and done. Cool. How you going? Yeah, so essentially, as I mentioned before, it's kind of like an abstract introduction, some sort of literature review, some sort of analysis section. Well, it depends on what you're doing, the questions. So most of these questions are more of they're not so much a case or a company per se. If you were to do a company, there would have to be a reason, has to be an issue or a question.
Back in time, back in India, there's a company which has been recently bankrupt. It was performing well from the past 20 years.
Okay. So how could you maybe frame that as an issue? You know, so I have 2 students, grad students that are doing research in that area right now, and so they're looking at predicting insolvency, or you could try and say do an analysis of the major listed enterprises that have become insolvent in the last 5 years. So that's a way to kind of look at it in a broader way. Well, I would say that it depends on the question, but for argument's sake, the question or your statement is, let's say the report focuses on an analysis of recent corporate insolvency events within the Middle Eastern drug sector. Okay? that could be like a framework, and then you would actually get data on those companies. So you look at all of those underperforming companies and try to find some common threads. What were the drivers behind their failure? What caused them to, for argument's sake? Yeah, that would be how I would sort of go about it. And then, you can try to go further to even do some predictive work if you want to. We had data on, pre-failure, whether it was pre-failure, non-failed companies, right? Whether you can build models to predict the ones that fail. I'm saying that's just an example. That's not what we expect you to do. But as an example, so there's so many different. It's an area of interest of mine. I do some work in insolvency prediction, so I think it's a good topic. But it's very hard to do a discussion of one company. Even the discussion of Amazon, although there was one topic that focused on one company, but it's relative to other ASX retail groups. Because it's very hard to do an analysis, there's no point of comparison.
They will give us,
Exactly. It becomes more of a general discussion of the company rather than an analysis. So every assignment must have some type of analytical framework or analysis. That can be qualitative, just be words, or it can be something. Yeah, exactly. No, so, and I would say most are going to be a combination of the two. But in your case, there's a fairly elegant way that you can do that by looking at a few different companies and looking at their pre-event performance and then looking at the common indicators here. Why did they fail? Yeah, and some of them in your number of traditional enterprises have failed and potentially failed in new industry. But for the most part, Indian enterprises adopt conglomerate models, so they tend to be much less prone to failure when they achieve success because they do equity. So Tata and Alliance versus others.
like they are more diverse.
Exactly.
They reach in every segment.
So it tends to be very infrequent where they fail in a number of different ways. But it can happen. So it's very, very different to here. It's more similar to Japan, where you see cross-holding businesses. In Japan, they have a Kiratsu, 5% cross-holding business model. Very, very similar to India. One difference is India, they're often family owned. India's quirky like that. Exactly. So that can cause problems. That's probably the only real functional difference. It's still very diverse. So, like as an example, I see Tata as very much a model Mitsubishi. Mitsubishi has Mitsubishi Electric, Mitsubishi Consultant, Mitsubishi Bag, Mitsubishi Automotive. Exactly. So, exactly. So Tata is a very good example in that sense. So I think there's a lot you can do. Just try to. Sometimes it takes a while to get points of comparison. So if you can take it up one step and look at factors leading to the corporate failure of Indian enterprises. That could be it makes it easier for you too. It's easy to look at. You pick one entity, one client, it makes your life easier. Trust me. Yeah?
I skipped I was not here for the two classes.
Yes.
Last 2 weeks. So how can I
Catch up. I can send you the material. The first 2 weeks are very easy. So just read it. Yeah. You come for a good one. So. All right. Did I put solutions up? Yes. I'm not sure if I have. Yeah, that is the right one. All right. So let's make a start. We are going to do a few calculations now. For those of you that are keen to sort of review any material from the preceding weeks, it's in the earlier segments, and I might even cover off on this in a few subsequent classes. The material from the first 2 weeks is rather basic, and you can self-study it. It's very, very basic mathematical calculations relating to capital allocation. But yeah, look, I might still cover some anyway over the course of the coming sessions, but I really do want to devote the majority of our time today just on this topic. This is a challenging topic, right? It seems really easy, but it can be challenging, all right? So we'll start with some of the theory and then we'll go into a few of the calculations. So, just a few general theory questions to get ourselves warmed up. What are the key considerations for central banks when engaging in monetary policy decision making? Monetary policy decision making. What are the key considerations? One very obvious one that always needs to jump out at you when you see any discussion of monetary policy, you should first be thinking about this critical consideration. That's exactly right. All right, so monetary policy is almost always geared towards addressing inflationary pressure. Doesn't have to be hyperinflation or any sort of extreme inflationary event. Inflation has significant impact upon the community. Have a look at the impact that inflation has had on certain segments of India. When the price of basic grains, the price of basic composites has gone up, it's had a dramatic impact upon the standard of living of many people in India in particular. And there have been similar issues arise from time to time in China. So managing inflation really matters. That's the key consideration for central banks. But try to remember at least two others. The question refers to consideration, which means that you need to provide at least one more. Okay? So what are the other considerations? Key considerations when engaging in a process of decision making. Well, I guess they consider indicators, but what drives the decision? So certainly potentially looking to stimulate the economy to address unemployment. But in Australia, there's one very critical one. The position of the economic cycle, undeniable. Yeah, that's a good, exactly. So the position of the balance of payments. And in Australia, rather uniquely, consumer credit and credit generally is very, very important to us because we evidence very high levels of credit. So our Reserve Bank actually talks about consumer credit and general credit, but it makes any declaration of policy. It might be a uniquely Australian thing, but I think that you'll find that more and more consumer credit will become relevant within other contexts and jurisdictions. All right, we've not talked about this one too much. We have, in a somewhat removed sense, this related to expectations theory, in a broad sense. What is, or should I say, explain what is meant by the Fisher effect as it relates to interest rates and currency. So has anyone seen that expression before? For those of you that have done any undergraduate studies in business and commerce, you would have covered the work of Irving Fisher. All right, he's a pretty impressive guy. Won a Nobel Prize. It's impressive to me anyway. He's up there with LeBron James in my view. Irving Fisher and LeBron James are like my 1 and 2. That's what I'm impressed by. LeBron did lead the Cavs to the finals, though. That's pretty remarkable. You guys would have learnt this in your undergrad days, I'm sure. That's exactly right. Thank you very much. The Fisher effect describes the relationship between the nominal rate and the real rate of interest. Why do I emphasise it in every single course? It is probably the most useful theory that you'll ever have in your arsenal when engaging with any exam, okay, that involves economics or finance, because it allows you to explain away a lot of complexity using a very simple model. Fisher's theory asserts that the current nominal rate that you observe in the market is a function of a real component and an inflationary component. So 1 plus the nominal rate equals 1 plus the real rate multiplied by 1 plus the rate of inflation. You did a lot of other work that meant that he won the Nobel Prize. It wasn't as simple as that. but it's nice and eloquent. It's a very straightforward way to explain what we observe on market. The nominal rate that we observe must incorporate both a real component and an inflationary component. Why is this useful to us in this course and in financial studies generally? Well, if someone asks you to explain a behaviour or something that you observe in the context of a nominal or quoted bank rate, you can explain that away by explaining changes in the underlying real rate conditions or changes in underlying inflationary conditions. It allows you to break down your answer into those subcomponents. So try to remember that when you're explaining away some sort of manifestation or evidence of behaviour, some sort of outcome in the market. The nominal rate is as it is because we've seen a change in inflationary conditions, for argument's sake. So with this theory in mind, what would we anticipate happening to the nominal rate if the real rate, if the rate of inflation goes up? What will happen to the nominal rate if the rate of inflation goes up? Yeah, it should rise also. So you can see it's a very simple and eloquent way to explain observed behaviour. Or I should say observed market phenomena. So question 4 just extends upon what we've just learned, explaining learnable funds theory of interest rates. If you were presented with a question like this in an exam setting, the easiest way to respond is to always use that diagrammatic example. But if you can't remember, you can do it in a qualitative way as well. That's entirely appropriate. Okay? So learnable funds theory asserts that the rate that we observe in the market is a function of supply and demand conditions, whereby supply derives from household supply, changes in monetary supply, and hoarding and dishoarding behaviour. The hoarding and dishoarding behaviour is the behaviour associated with removing or providing funds to the financial system depending upon the incentives provided by the system. Demand is a function of inelastic government demand and traditionally elastic business demand. All right. Okay. This next question is a kind of challenging one. It won't be obvious to you, but it's hard to verbalise responses to simple things sometimes. So you would see market practitioners talking about implicit rates of interest quite frequently. They'll talk about the implicit rate is for this term is, or the rate that's implied given current market conditions. The rate that we can offer given current market conditions is the following. What is meant by the concept of an implicit rate? What is meant by the concept of an implicit rate? Okay, as the name would suggest, it's a rate that is implied by an underlying set of rate conditions. So an implicit rate is a rate that we derive from a longer rate interval or a series of shorter rate intervals. If, for argument's sake, we're trying to derive a longer rate interval, we require shorter term rates to derive that longer term interval. If, for argument's sake, we're trying to derive a short term interval rate, we require a longer rate set to do that. So it's a rate that is implied by or derives from another set of rate conditions. It's not a known or quoted rate, it's a rate that derives from the existing or presented rate conditions. It's implied by the rates. All right. Okay, these next questions are rather basic, so we'll move on. Okay, let's have a look at question 10 now. So question 10 is indicative of the style of question that you might see for a few marks on your paper. Okay. Question 10, you are provided with the following interest rate information. 0I1 is 7%. E1I1 is 8%. E2I1 is 9%. And E3I1 is 10%. Nice, neat, upward sloping curve. Let's go through the notation one more time, because the notation does take some time to come to terms with. There's nothing wrong with that. Notation always does. 0I1 denotes what? That first number corresponds to the starting point. That's exactly right. The second number corresponds to the term or the interval. When there is no prefixed E, it's a known rate rather than an expectation. Okay? This is standard notation. So E1I1 under these conditions must be what? The expected 1 year rate in 1 year's time. E2I1 must be the expected in 2 years' time. Yeah, exactly right. And finally, E3I1 is the 1 year rate in 3 years' time. So we now technically have all information that we require to calculate all rates between now and the current 4 year rate. We can calculate all of those implicit rates. Okay? We have all the information that we need. So let's go about calculating 0I2. How would we go about calculating 0I2? From first principles without a formula. We'll start from first principles, you always be given a formula.
0I1 plus
Okay. This is where we diverge ever so slightly from the basic arithmetic average. Remember in the real world we have to account for compounding. So how would we vary that standard approach to account for compounding? Very, very simple way to vary it. We will simply acknowledge now that we're calculating the value of 1 plus 0I2. 1 plus 0I2 equals 1 plus 0I1 multiplied by 1 plus E1I1. So let's write that out. Just to make it a little bit clearer, we'll do it in Excel, just because Excel is such a wonderful tool. If you don't have a copy of Excel, you need to get one, just because it's fun. All right, when you've got some time, jump into Excel. Then if you want to have even more fun, then you can jump into R or Safer and whatever. We'll do that too, but Excel is a really good starting point. So we're going to do our calculations. It's always best to do things neatly, okay? So we record everything here. 0I1. Then we do E1I1. E2I1. E3I1. And that's it. All right. And so my first rate from memory is 7%, but I will just confirm that so I don't make any mistakes. 7, 8, 9, and 10%. Okay, so we have 0.07, 0.08, 0.09, and 0.10. Our goal is to find, we'll do it in a tabular format, we want to find what? We want to find 0I2, 0I3, and 0I4. Okay, so what we're doing here, try to think about what we're doing, because there's only going to be two separate conditions you will encounter in an exam in relation to rates. Yeah, there's a little bit of maths, but only two separate conditions. One, where you use short intervals to extrapolate a long rate. Okay, and you use the relevant formula then, which I will give you. The other is where you use a long rate interval to find a shorter interval rate. So it's either one set of operations or the other, going one way or going the other way. So we'll do it first principles, but as I said, you will always be empowered with an example that also gives you the formula. So 0I2 must be equals, bracket, 1 plus 0I1 multiplied by 1 plus Okay, so does that seem right? What do we need to do that we haven't? Very good. Because this rate denotes the aggregation and compounding effect of both intervals. We want the annual rate each of those 2 years. So we need to do one more thing. And the great thing about this is it's really easy to remember how to do. If I'm solving for 0I2, there is going to effectively be a squared symbol on one side. I'm squaring or accounting for the compounding effect by squaring on one side. To accommodate that, I need to take the inverse power, or do what? What should my power be? What am I doing? Didn't see my 2. There we go. And we want a nice neat number at the end, so it's equals -1, and we have our first answer. Okay. All good. Fantastic. Please ask questions. I'm going to give you all of these answers in a PDF with steps as well, don't worry. But if we do it that way, you won't pay attention to the steps now. I know this because I've tried it both like this. Cool. All right, let's do the next one. So we've got 0I2 now. I don't know why I did that there. Let's undo that. All right, so I'm going to be a little bit lazy if you guys don't mind, and I'm just going to copy that down and just replace the values. Okay. So I don't even need to replace the values. I'll just add 1 in front. 1 plus. Okay, is that correct? Well, it's not correct because on this occasion, I can't take it to the power of 1 on 2. I must take it to the power of 1 on 3. Think about the equivalent power on one side that I need to account for. Okay? It's the 3-year rate. Okay, that's the rate that I'm going to earn the power of 3. I'm going to earn this amount, and this amount, or I'm going to earn an alternative rate taken to the power of 3. So if I'm earning this amount, and this amount, that's taken to the power of 1, that's taken to the power of 1, that's taken to the power of 1. I need the equivalent here. Okay. We'll just do the last one. Right, just do. I think I changed the wrong one. I did. What am I doing? Sorry, guys. Give me a second. All right, so these are our answers. As an investor, I am indifferent between receiving 7% year 1 and 8% year 2, or 7.49% squared. As an investor, yes?
Why you use the geometric
To account for compounding. So, yeah.
And why didn't use real I2 to calculate real I? I started using the real I2 plus 1.
I could. I'm just doing it to do it.
It's the same thing?
100% the same. Yeah, 100% the same. Yeah. Oh, yes, my apologies. If it's not clear, please let me know. I'm looking at it a little closer, I think. Sorry, if I don't have my glasses on, I wouldn't be able to see it if I was standing there. For those of you taking photos, I'm going to give it to you anyway. There's no surprises here. Would you prefer that we do it outside of Excel first? I'm happy to do it either way. The only problem with just doing it with a formula, I find, is that people don't learn the logic. But I'm happy to do it that way. Okay, I'll get the material out of the earlier version of the course where we did it that way. And we'll go through it. Just so you can display them. Yeah, it is a little bit hard to see. I do take your point. Let's figure out what we can do. Yeah, no, I'm trying to think about doing that, but I know people want to take photos of the answers right now. Do you know what I'll do? This is the best thing for me to do. Hold on one second. No, I'm just going to do something. Give me one sec. I'll put them down here, and we'll paste them, not as values, just as they were. Not transpose. Oh, it needs references. Hold on one second. Special values. Then I'll just get rid of equals enter. Cool. All right. What I like to, it's okay, I might just do the remaining questions in Excel, and I will next week, I'll do them all for you in the formula too. Okay. So you can just learn how to do it the formulaic way as well. All right, so we have a few more questions to do. We might just do one, just to sort of start with. We'll save the remainder for next week. It should be fun. Okay, so we have question 10 now. This is the alternative scenario that you might encounter. All right, so we're required to calculate the interest rates with the provided information. Now we have the current 1-year rate, the current 2-year rate, the current 3-year rate, and the current 4-year rate. Okay? What we need to do is calculate the 1-year rate in 2 years' time, the 1-year rate in 3 years' time, 1-year rate in 1 year's time, and the 2-year rate in 2 years' time. All right? If you know what you're calculating, very hard to make a mistake. All right, so the first principles approach to this involves you figuring out what you need to calculate. Today we'll just do 2I1, we'll do the others next week. All right. So particular attention is needed for this one. When you're calculating a particular interval rate, you need the following two things. You need a rate that brings you to that relevant point, and you need a rate that covers the entire interval. What do I mean when I say that? Well, when calculating 2I1, that is the 1-year rate in 2 years' time. To calculate that, I need a rate that brings me to the 2-year point. I then need a rate that covers the entire interval, the 3-year rate. The difference between the current 2-year rate and the current 3-year rate must be the 1-year rate in 2 years' time. All right? So think about it this way. We'll do it in Excel again. I'm just going to write it out as an equation, so it looks like the formula. Okay, so I'll write it out without the equals so you can see it as I do it. We're going to have, on one side, the rate that we're after. Okay, what's the rate that we're after? Yeah, exactly. So we'll write in full notation, 2I1. Okay, actually, I'm doing it without the 1. 2I1 square, oh, actually it's not squared in this occasion. Just got 2I1 is 1 year rate, so no square. Okay, equals. On this occasion, we need those other rates. And so 2I1 must equal the difference between the following two. Okay? 2I1 must equal the current 2-year rate, 1 plus 0I2, and okay, so it must equate to the difference. How do I account for this? So the equation, to start with, looks a little bit confusing. We have the unknown rate, and we'll have two known rates. I can't have 0i2 on this side. I need to move it across here to meet the conditions of this equation. So, to start with, 1 plus 2i1 and 1 plus 0. Anyone? What two rate conditions multiplied with each other will give me the unknown? So 0i2 is the 1 year rate in 2 years' time. All right, I'm just going to write it out. It's all good. Okay. So I have the following three rates. I'm not going to put anything in here until we've come to terms with the underlying logic. All right, these are the three rates that I have. Okay, 0i3 squared must equal the other two. So what order should they go in? I'm just going to leave those there for now. Okay, if I was to write out a formula or an equation that makes the left-hand side equal the right-hand side, what would it be? 2i1, okay, is the rate from year 2 to year 3. What is the rate that goes from year 0 to year 2? Yep, that's it. All right, so we do it as the 2 year rate in 3 years' time. The 2 year rate, 1 plus 0, exactly. Multiplied by? Good. 2i1 equals 1. Very good. Okay. What are the powers? Very good. Okay. And so what do we do next to solve for the unknown? Don't worry, we're going to do this with the formula next week. We'll just start, we're going to do it based on logic. Everyone's like, I don't care about logic. Just want to get to the answer. All right, what do I do next? Help me out. I'm going to have to pick on you, I'm sorry. You're looking at me at the moment. All right. How do I get to the answer, guys? What's my unknown? 2i1. So all I need to do is, okay, bracket 1 plus, this is essentially your formula, 0i3, close bracket, power of 3, divided by bracket 1 plus 0i2 1 plus 2i1. There is a very simple set of three formulas that I'll give you that will account for all these. Okay, so we use the notation n to denote the first number and k to denote the second number. So our formula is essentially n plus k numerator, n denominator. You always get the correct answer. The problem with that formula is it doesn't explain to you what's going on. Okay. Well, that's enough for today. As I said, that's just some of the logic and some of the theory. Next we'll go through it using the standard equations. Okay? In fact, I'll give you the formula sheet in advance. You can have the formula sheet now. Right, I hope that was fun anyway. Was that fun? Good. All right. So we'll figure out other ways to do it next week. We'll also go through some related financial maths. Please bear in mind these two questions. This question, last sentence of the discussion in final paper. Oh yeah, sure. Yeah, drop me an email.
Michael, Robert.
Nice to meet you.
Yeah, how are you?
Good, thanks.
I was just looking at the assignment, which is crowdfunding versus IPO.
Yes.
Sounds interesting. National, international.
Well, I'm kind of allowing people to give it their own flavour.
Okay.
I obviously kind of reasonably familiar with North America and Australia in terms of data and guidance, but would love for people to look beyond those markets
Okay.
too.
So I could look at national, I could look at the US, I could look at Australia.
Most certainly, you could do it from a comparative perspective if you wanted to.
Yeah.
The data in Australia is much more sparse.
Yes.
It
Right.
is much easier to do from a North American perspective,
Yes.
but far less interesting because it's obviously been done to death in that context.
Yeah.
Yeah, it's entirely at your discretion. Do you have? I mean, if you have an interest in the space, and I think Australia is a good starting point, albeit a little bit more difficult. But Outcal provides data,
Yeah.
and you can also get a little bit of data from the ABS,
Yes.
the other data monitor service, and I believe that there is some data provided by FinTech Australia as well.
Okay. All right. Can you give me some guidance on that? If I
Drop me an email and I'll
Yeah.
drop you one back. Yeah.
Any sort of academic stuff on that? Any journal articles or anything?
Yeah, look, there are. I at this level, it would be lovely if people use a lot of that material, but it's not going to be so onerous as to suggest it's the only thing that you should do at this level. It's kind of at your discretion a little.
Yeah.
I would say yes if you're familiar enough with kind of finding that stuff.
Yeah.
Can't yeah.
Yeah.
It's just going to make your life much easier anyway.
Yeah.
And find a good
But
kind
it's
of
around, though.
good kind of archetype and
Yeah.
go from there.
No worries.
So we look forward to getting an email. Cheers. No, it's like an open space. You'll find me at second desk, second space. Yes, of course. You're welcome to do one of those. There are more placeholders, so you can change it. I thought people liked doing those. No, all right, okay. It takes. Well, I'll give it to you in. If you want to, yes, of course. So there's no memory memorization. You get 23. And you probably only use about 7. All right, well look, we're out for an online document, and then after we'll do the resource section. That way, because that's the arithmetic average. That doesn't account for compound. So, a geometric average involves one rate in the average. That calculation is simply a simple average. It's a geometric average. I'll give you guys a copy of the rules.
My colleagues will be waiting.
We'll talk outside.
I don't see him walk in, sorry. Yeah, I'll give you a quick, have a quick word with you outside only because some people are waiting. Is that okay? I'll be like 2 seconds.